Your home and mortgage connection.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome to Ron Siegel Radio. This is the show with no real boundaries. As we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media, this is the show that connects the dots of confusion. Delivered by conflicting media reports, we connect the dots so you know the actions you can take. How your family or business can benefit in current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We have a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. And to remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you. And you can reach out to me directly, 800-306-1990, 800-306-1990, or RonSiegelRadio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan or plan to save you money, I personally work with you, even if you don't have any needs today. Save this number in your phone for future reference, 800-306-1990, 800-306-1990. And yes, we're celebrating today. We celebrate every day on Ron Siegel Radio. Let's see what we've got exciting to celebrate today. So it is I guess it's a synergy day. I didn't know whether I should go with synergy or conflicting, but I guess synergy is probably the right word to use here. So we've got National Homemade Bread Day. And yes, I do like homemade bread. Although, not supposed to eat too much of it anymore. But when you have that homemade bread, what is better than homemade bread goes better with it? No, not bacon. We're not going that direction today. But how about butter? Because today's also National Butter Day. So I think we can go back and forth on those, Josh. National Butter Day, National Homemade Bread Day, Butter Day, Bread Day, or you just do both of them at the same time. But, I'm going to share with you something personal. So I've been on this wellness journey, and part of the wellness journey has got me losing weight, but also several other products I'm using. Now I'm starting to study them. So yes, if you want to go to rsrlinks.com/shot, we have been talking about that, but went under another milestone. I haven't been this light, and no, I'm not light. I'm still overweight, but haven't been at this weight, I think it's since college. So, I haven't been under 250 pounds, and I can't even remember how long. Yes, I know there's some of you that look at 250 and say I'm nuts. It's an amazing amount, but I've lost 108 pounds so far. Now the question is, I was with a group of people the other day. A lot of them didn't even weigh 108, and I've lost 108. So can't have too much of the homemade bread and butter, even though we are celebrating that today. But we're also celebrating National Baklava Day. So which direction do we go? Now that baklava, I don't know what that green stuff is on baklava. I know it's always there. I don't know what it is, but baklava is good stuff. And there's a restaurant not far from us here in Anaheim Hills that makes some really good baklava. Ever been to Rosine's? Yeah, that's it. Now, I like their lentil soup as well, but I digress. Can't do the whole show on things we want to eat. Well, why not? Maybe we could do that. We could also go into, what you want to eat and how does it pair with red wine. Now, I'm not one of these big guys on pairing stuff. I like it or I don't like it. It doesn't matter. So yes, I will have fish with red wine. I'll have pork with red wine, turkey with red wine. I'm not a big white wine guy. I think in our collection, maybe 5% is white wines. Josh, you a wine guy? Red, white, big bolds. What direction do you go? I'm not a big bold. My wife likes big, bold cabs. I'm not into that big, bold stuff. I like a nice mellow Zinfandel. So you're a red guy too. Zinfandel or Merlot, not white Zinfandel. That's not real red. That's not. Well, you ever hear the story of where white Zinfandel came from? How's this a home and finance show? But I like talking about this stuff anyway. White Zinfandel was actually a mistake. They left the skin on a little too long, and they got white Zinfandel. But I digress. So we've got national homemade bread, we've got butter, and we've got baklava today. Sounds like a balanced diet to me. Let's say, speaking of balance, let's see what the markets are doing today. Do we want to see what the markets are doing today? Looking at the Dow Jones Industrial Average, down 4.67. The NASDAQ is up 50. Oh, it just jumped up 65 points. S&P 500 is up 12.95. Oil's down a penny, $60.08 per barrel. And what's going on in California? Well, the rest of the country's prices are going down. Ours continue to increase. We're up again just a little bit from yesterday. 307 is the national average. 467, up $1.60 higher in California than the national average. Thanks, Gavin. Washington is at 419 and Hawaii is at 446. Other than that, everybody is in the low $3, well, in the $3 a gallon range. We about 360 over there, Josh? 350, 360. Yeah, so they're in the mid threes, and they're still one of the top 10 highest priced states in the country. But, California, we like to be the leader. Gavin likes to lead everything, right? High gas prices, high homelessness, high taxes, highest unemployment. That's Gavin's world. And he wants to take that to a neighborhood near you. So as you're watching and looking at his next step, he wants to be the next president. So he can do the same things to the rest of the country that he's done to California and San Francisco. I wonder where people will move to, because they move out of California since Gavin's been other than the illegal population, but they move out of California since Gavin's been governor. I wonder what's going to happen with the country. Will they move out of the country too? Unbelievable. What else is going on in the world? We're going to get a jobs report later this week. So it looks like the September jobs report that would normally come out the very first Friday of November. We're going to get that one, it looks like, on Thursday this week. They're expecting 50,000 jobs to have been created back in September. Job market's not looking real good, other than in the opinion of certain people. But I digress. The 10-year Treasury is down a little bit. Mortgage bonds are up a little bit, means rates are down just ever so slightly. Now, we'll tell you in a minute about the where rates are, because I got a lot of misconceptions about rates. So we'll talk about that in just a minute. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. When we come back, we got a great broadcast lined up for you today. The housing market's turning a corner going into 2026. We have the 2026 tax brackets. We'll talk about that. How to avoid becoming another divorce statistic, and understanding tax brackets. And we've also got tax brackets dropping. So two different stories on that. You're listening to Ron Siegel Radio. Again, you can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you missed any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Are you a veteran, own a home, and need money? The Siegel Lending Team is here to help veterans refinance and get the money they need. The VA 100 lets you borrow up to 100% of your home's value, refinance your mortgages, consolidate credit cards, and lower your payments by an average of $700 a month. And the Siegel Lending Team knows that character means more than a credit score. Call 800-306-1990. That's 800-306-1990. Rate subject to change without notice. Licensed by the California Department of Corporations, NMLS 21037, and DRE number 018694452. You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by rsrlinks.com/mobile app, rsrlinks.com/mobile app. And what did every day at this time, OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. What did rates do on Friday? Now, again, they don't tell us points paid, points received, or the APR. That is a point of confusion for a lot of people because they're hearing, oh, the rate is 6. But Friday, I'll give you an example. Friday's 30-year fixed rate conventional loan, 6.229. That was up a little bit. And I hear people say, well, is it 6, Ron? Is it 6.5? Is it 7? I hear all these different numbers, and they're probably all correct, because these are the averages. So I could show you, and I do with our private clients, what are the rates going to be? You could pick your rate. You want to rate at 5? No problem. You want to rate at 7? No problem. Strategy beats rate always. So on average, 6.229. Jumbo 30-year fix, 6.671. That was up. FHA 30-year fix, 6.088. That was up. VA 30-year fixed, 5.829. That was down. And the USDA 30-year fixed, 5.998. That was down. Now, if you want to know our thoughts about the market, and yes, we have already published them today, go to the Ron Siegel Radio community. You can get there, rsrlinks.com/HBOD. rsrlinks.com/HBOD. That's where you can get our latest thoughts on what's going on in the mortgage market. Again, we put that out each morning, and you can go right there, register. It's free to you. We put a little work into it, so we want to make sure that you're getting the good stuff. It's not a repeat of what I'm telling you right now in the Mortgage Minute. There's more data in there. We just don't have time to put it all into the broadcast. So what are rates doing right now? Well, the 10-year Treasury down 2.4 basis points. So it's at 4.127. The S&P 500 is now up 12.7. And we're looking at the 30-year bond, 30-year mortgage bond. This is the 5.0 coupon for January, is up 6 basis points. Got a little better since we last spoke. So as I mentioned previously in the last segment, Bureau of Labor Statistics announced they'll be releasing their September jobs report. Yes, we are in November, but due to the government shutdown, the September report was not released. So they're going to release that Thursday at 5:30 Pacific time. The market is expecting to have been 50,000 jobs created in September, and for the unemployment rate to have remained at 4.3%. All the private and ancillary jobs data has been pointing to weakness, including ADP's employment report, which showed 29,000 job losses in September. ADP released their report for October as well, which showed 42,000 job gains. Bottom line, over the last 3 months, there have been a total of 10,000 jobs created, which is flatline growth. As far as the unemployment rate goes, the market is expecting to remain stable at 4.3%, but the Chicago Fed's unemployment rate indicator, which predicts where the BLS unemployment rate will be, is pointing to 4.36% for September on a rounded basis. It would mean the unemployment rate rose from 4.3 to 4.4, which would be helpful for bonds. Many Fed members have said that the labor market is either stable or even solid, explaining that although demand for jobs has been low, supply has been falling as well, but the amount of available workers looking for work is actually up 8.1% year over year, despite immigration changes. That points to demand really being the issue, which is a warning sign in the labor market. And once workers are let go, it's much harder to find a job. 26% of unemployed individuals have been without a job for 27 weeks or longer, which is the highest in a decade when removing COVID and points to less hiring. This syncs up with the continuing claims figure, which is around 2 million, showing it's harder to find work once let go. All of the soft survey data is underscoring a weak labor market where people think the unemployment rate will be higher a year from now and that it's harder to find a job. Lastly, layoffs have been on the rise. Several large companies have announced big layoffs. And last week, Challenger reported 153,000 job cuts in October, which was the highest amount in over 20 years. Some pointed to the shutdown as the reason for the increase in layoffs, but in Challenger's breakdown, only 9,000 out of 153,000 were attributed to the shutdown. About 1/3 was due to cost-cutting measures, and the second biggest reason was AI. That means that since the shutdown is now over, there's not going to be a big amount of the cuts reversed, and there is true weakness. Fed governor and voting member Philip Jefferson spoke this morning and said he was in favor of cutting October 29th because he sees risks to the labor market and feels that there has been progress on inflation moving lower when removing the temporary impacts of the tariffs. He does feel that the Fed needs to proceed carefully, as he thinks the Fed is only somewhat restrictive. So long as the data is released ahead of the December 10 meeting and it continues to show a weak labor market, he seems like someone who could be convinced to cut once again. CoStar Rent Report released a multifamily rent report showing that rents fell 0.3% in October and are only up 0.8% year over year. The annual increase is about half of what was reported at this time last year, and the decline in rents over the last 3 months are some of the largest they've seen in 15 years. This is important for inflation. Shelter, which includes rents, is the largest component of the CPI and PCE reports because the decline in rents is accelerating. This is a good thing for further shelter decreases and lower overall inflation. That is the Mortgage Minute, brought to you by rsrlinks.com/mobile app, rsrlinks.com/mobile app. Now, I think tomorrow, we've got on our schedule that we're going to talk to you about strategic refinances. And I'm going to have some charts and goodies for you then. So you're not going to want to miss this, because right now people are thinking about, you're dealing with holidays and what can you afford? What's your budget going to be for holiday gifts? The strategic refi is a very, very interesting product. And a lot of people don't understand it. A lot of people don't deal with it. But the strategic refi is one of those tools. And again, I tell you, strategy beats rate always. So it's one of those tools that we look at and we ask the question, are we cutting rate? Are we cutting our debt service, the amount of money we have to pay every month for all of our debts? And are we cutting the duration, how long we still have on making our paying off our debt? So we look at all three of those. And the strategic refi looks at those, again, strategically. And one of the things that almost always happens is we're able to cut time off the duration of your loan. Now, do I like the 30-year loan? Yes. I am not a fan of a 15-year loan. And the reason I'm not a fan is it does not give you any liquidity and it doesn't give you options, and it's harder to get. The 30-year loan, and again, most people have that, gives you options. And what do I mean by options? Well, if it's your primary residence, there's most likely not going to be any kind of a prepayment penalty. There might be some programs that have prepayments, but generally you're not going to have a prepayment penalty. So that's a big benefit. Now, if you're saving $1,000 or $1,500 a month doing the strategic refi, what would happen if you put half of it or all of it toward your principal of that 30-year loan? If your goal is to pay off your mortgage, and that's just another strategy, because if you've got an extra $1,500 a month cleaned out of your budget, I want you to be disciplined. And I introduce you to some folks that can show you how to take that money and maybe put it into a life insurance policy if you qualify. And again, I don't offer the programs. I just know the people that do. But you put it into a life insurance policy that the cash value is growing. So now you're going to probably be able to write a check to pay off your mortgage in 20 or 25 years, that 30-year mortgage. You can probably write a check to pay it off in 20 or 25 years. You're keeping your benefits as far as your your interest expense deductions. Again, if you qualify, and I'm not giving tax advice, but if you qualify for an interest deduction, you're keeping that. But because that money in that insurance policy is growing faster than and compounding faster than your mortgage expense, you're able to pay things off much, much quicker. So just a thought there. Now, we're going to go get into it deep, and I'm going to give you numbers and examples and all that tomorrow on the strategic refi. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, the housing market is turning a corner going into 2026. Tax brackets drop, but your debt payments didn't. How to avoid becoming another divorce statistic. All that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home? Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Real-time real estate segment today being brought to you by rsrmoney.com, rsrmoney.com. Housing market turning a corner going into 2026. After several years of high mortgage rates and hesitation from buyers, momentum is quietly building beneath the surface of the housing market. Sellers are reappearing. Buyers are re-engaging, and for the first time in what feels like forever, there's movement happening again. No, it's not a surge, but it is a shift, and it's one that could set the stage for a stronger year in 2026. So what's driving the comeback? Here are 3 big trends that are slowly breathing life back into the housing market right now. Number 1, mortgage rates have been coming down. Mortgage rates are always going to have their ups and downs. That's just how rates work, especially with the general economic uncertainty right now. Some volatility is to be expected. But if you zoom out, it's the larger trend that really matters most. And overall, rates have been trending down for most of the year. If you're watching us on RonSiegelRadio.tv, any of our socials, or the ABC News and Talk AM 1490, FM 98.1 video feed, you are seeing a chart of mortgage rates trending down, and the chart goes for the entire year to date. Just the last few months, we've seen the best rates of 2025, according to Sam Cotter, chief economist at Freddie Mac. On a median priced home, this could allow a home buyer to save thousands annually compared to earlier this year, showing that affordability is slowly improving. Here's why that matters for you. This shift changes what you can actually afford. It means lower borrowing costs and more buying power. Take this as an example. Data from Redfin shows a buyer with a $3,000 monthly budget can now afford roughly $25,000 more home than they could a year ago. Big deal. And it's just one of the reasons why activity is picking up. Number 2, more homeowners are ready to sell. For a while, many homeowners stayed put because they didn't want to give up their low mortgage rate. That lock-in effect kept inventory tight, and while plenty of homeowners are still staying where they are today, the number of rate-locked homeowners is starting to ease as rates come down. Life changes are becoming a bigger part of what's driving more people to move, and that's opening up more inventory. Data from Realtor.com shows just how much the number of homes for sale has grown. And the really interesting part is that the market is approaching levels that haven't been seen for the past 6 years. You're looking at another chart. Inventory continues to grow. That return to more normal inventory levels is a really good thing. It gives buyers more options than they've had in years, and it's helping to bring the market closer to balance. More buyers are re-entering the market is number 3, and that's not just sellers making moves. With more options and slightly better affordability, buyers are getting back in the game. The Mortgage Bankers Association, MBA, reports purchase applications are up compared to last year, a clear signal that demand is building again. And we've got another chart for that one as well. Buyer demand up compared to last year. And don't forget, if you're having the affordability issues, before you ever ask for a price concession, ask about a rate concession. rsrlinks.com/buydown. rsrlinks.com/buydown. Experts think this momentum will continue. Economists from Fannie Mae, the Mortgage Bankers Association, and the National Association of Realtors all forecast moderate sales growth going into 2026. Now, this recovery won't happen overnight. It's not a flood of activity, but it is the start of steady improvements going into 2026, and that's something a lot of people have been waiting for. Bottom line, after several slower than normal years, the market is finally starting to turn a corner. Declining mortgage rates, more listings, and growing buyer activity all point to a market gaining real traction. Got any questions? Give me a call at 800-306-1990, or you can visit any of our socials, direct message me, smoke signals, we answer everything. That's the Real-Time Real Estate segment brought to you by rsrmoney.com, rsrmoney.com. Borrow Smart segment today brought to you by gethomeselect.com, gethomeselect.com. You know what nobody talks about at engagement parties? Money. But here's the reality. Nearly 1 in 4 divorces happen because of money problems. Over half of people say their partner's debt would be a major reason to consider divorce. That's not romantic, but it's true. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Today, we need to talk about something that could save your marriage before it even starts. Having the money conversation. Here's what I see all the time in my practice. Couples come to me after they're already in trouble. They're sitting across from each other, and one spouse had no idea the other had $80,000 in student loans. Or they thought they agreed on buying a house, but turns out one partner wanted to save cash while the other assumed they'd borrow everything. These aren't small disagreements. These are relationship-ending surprises. So let's talk about what you need to discuss before you say I do. First, the current situation. You can't build a financial future together if you don't know where you're starting. That means complete transparency about income, assets, savings, investments, and yes, debt. I had a couple come in last year, great people, really in love, but he didn't know she had $45,000 in credit card debt until they applied for a mortgage together. The shock wasn't just the number. It was the fact that she'd hidden it for 2 years. Here's the thing about debt. Your partner's debt doesn't automatically become yours when you get married, but it absolutely affects your household budget and your ability to borrow together. When lenders look at your joint mortgage application, they're looking at both credit scores, both incomes, and both debt loads. That's your household blended interest rate in action. Credit scores matter too. Marriage doesn't merge your credit scores. But if you're applying for loans together, lenders typically use the lower score. I worked with a couple where one had a 780 credit score and the other had a 620. When they applied together, they got rates based on that 620. Cost about $300 more per month than if the higher scoring partner had applied alone. Next, you need to talk about spending habits and money values. Are you a saver or a spender? Do you think money is for enjoying now or building security for later? Seen marriages strained because one person thinks a $50 restaurant meal is normal and the other thinks it's wasteful. Neither is wrong, but you need to know this about each other before you merge your lives. Then comes the practical stuff. How are you going to manage money during marriage? Who pays for what? Some couples split everything 50-50. Others do proportional splits based on income. Some assign categories. When one handles the mortgage, the other covers groceries and utilities. There's no perfect system, but you need a system that both of you agree is fair. And here's a critical question. Are you having separate accounts, joint accounts, or both? I typically see couples do best with a combination. Joint account for household expenses, separate accounts for personal spending. That way nobody feels controlled, but you're still building together. Let's talk about goals, short-term and long-term. One couple I worked with, he wanted to buy a boat. Within 2 years, she wanted to save for a house down payment. Both are good, valid goals, but they require different financial strategies. You need to know your top 3 goals and your partner's top 3 goals. Find the overlaps and make those your shared priorities. Emergency funds matter. You should have 3 to 6 months of expenses set aside. If you don't have that cushion yet, how much are you each going to contribute each month to build it? And what qualifies as an emergency? Believe it or not, couples argue about this. Major purchases need this discussion too. How much can one person spend without consulting the other? Is it $500, $1,000? And how are you going to handle big decisions like buying a house or having kids? These affect your entire household budget and your wealth building strategy. Here's something people don't think about. Lending money to family members. This can create serious friction. Would that come out of personal or shared accounts? What's the limit? Better discuss it now than fight about it when your brother-in-law needs $5,000. And retirement. Even if you're young, you need to talk about this. How much are you saving? What accounts? Are you maximizing employer matches? Do you want to retire early and travel or work longer and maintain your current lifestyle? Your answers affect how much you need to save today. Now, here's how this all connects to strategic debt management. When you're planning your financial life together, you need to look at your complete household situation through the lens of safety, liquidity, and return. That's how you evaluate every decision. Safety, are you protected if something goes wrong? Liquidity, do you have access to cash when you need it? Return, are you building wealth effectively? Most couples focus on paying down debt or saving in retirement accounts. But remember, strategy beats rate always. It's not just about having the lowest interest rate on your mortgage. It's about knowing all your financial pieces work together to support your life goals. I had a couple recently getting married next spring. They came in with a list of debts, his student loans, her car payment, and credit cards for both. After looking at their complete picture and running the numbers, we repositioned their debt to reduce their monthly budget impact by $840. That's $840 more per month they can use for building their emergency funding, saving for a house, or yes, enjoying their lives together. But we can only do that because they had the conversation before marriage. They knew exactly where they stood. So what should you do? Whether you're engaged, thinking about getting engaged, or helping someone who is, start the conversation and get your financial house in order before you combine households. Go to rsrlinks.com/keysteps. rsrlinks.com/keysteps. This tool will help you organize your financial picture so you can have this conversation with clarity and confidence, because the couples who talk about money before marriage, they're the ones still talking after marriage. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. That is the Borrow Smart segment, brought to you by GetHomeSelect.com, GetHomeSelect.com. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, it's unfortunate, but we got to talk about taxes now. It's that time of year. No, taxes are not in April. Smart people are dealing with their taxes in October and November. So we're going to talk about that when we come back. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Your Credit Matters segment today being brought to you by rsrlinks.com/debt-free. rsrlinks.com/debt-free. Here's something that might surprise you. If you got a raise that pushed you into a higher tax bracket, you did not actually lose money. Sounds backwards, right? But understanding how tax brackets really work could change the way you think about your household finances. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Let me share a story about a client who recently called me pretty upset. She'd just gotten a promotion with a $10,000 raise, and somebody at work told her she'd actually take home less money because it would push her into a higher tax bracket. She was seriously considering turning down that promotion. I hear this all the time, and it's based on common misunderstanding about how tax brackets work. So let's clear this up once and for all. The federal tax system uses what's called marginal tax brackets. Think of it like climbing stairs. Each step up represents a different tax rate. But here's the key. You only pay that higher rate on the income that lands on that particular step, not on everything below it. Let me give you a real example. Say a married couple filing jointly makes $210,000 in taxable income for 2025. People see that some of their income falls into the 24% tax bracket and think they're paying 24% on everything. Not true. Here's how it actually works. Their first $23,850 is taxed at 10%. And yes, if you are watching us on RonSiegelRadio.tv or any of our socials, you are seeing a chart that shows this. So their first $23,850 is taxed at just 10%. Then the income from $23,851 up to $96,950 gets taxed at 12%, and so on up through the brackets. Only that last $3,300 over $206,700 gets hit with the 24% rate. When you add it all up, their actual total tax rate, that's 17.2%, not anywhere close to the 24%. So what does this mean for you? First, never turn down a raise because you're worried about tax brackets. You'll always take home more money, even if a portion gets taxed at a higher rate. But here's where this connects to what I do every day with strategic debt management. Understanding your real tax situation is part of the bigger picture. When you're looking at your household budget, your actual tax rate matters way more than what bracket you're in. Let me explain. When families come to me looking to reposition their debt, we're analyzing cash flow. I need to know how much money is actually coming into the household after taxes and how much is going out to service debt. That household blended interest rate we talk about, it only makes sense when we compare it against your real take-home pay, not your gross income. I had a couple recently who thought they were in great shape because they were only in the 22% bracket. When we calculated their effective tax rate, it was closer to 15%. That extra cushion in their actual take-home pay meant we could be more aggressive with repositioning some higher interest debt without stretching their monthly budget. Now, here's something most people don't think about. Your tax bracket can also affect how we evaluate different debt strategies. Remember, strategy beats rate always. Sometimes taking a slightly higher mortgage rate makes sense if it gives you the liquidity to handle other opportunities. But we can only make that call when we understand your complete financial picture, including how taxes actually impact your household. For 2025, there are 7 federal tax brackets ranging from 10% to 37%, with 4 different filing classifications. But again, remember, these are marginal rates, not your effective rate. Bottom line, the tax code is over 2,000 pages long. You don't need to understand all of it, but knowing how marginal tax brackets work, that's a foundation piece that helps you make better decisions about your money. If you want to get your complete financial house in order and see how tax planning fits into your strategic debt management strategy, rsrlinks.com/keysteps. rsrlinks.com/keysteps. We got a tool there that'll help you see the whole picture. And remember, strategy beats rate always. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. And that's the Your Credit Matters segment, brought to you by rsrlings.com/debt-free. rsrlings.com/debt-free. Let's see. Borrow Smart segment brought to you by gethomeselect.com. Gethomeselect.com. Here's a question for you. Would you rather pay taxes on $50,000 at 22% or at 12%? If you said 12%, you're in luck. The IRS just announced changes for 2026 that could keep more money in your pocket. But here's the catch. Most people won't realize they're eligible for these breaks because they're not looking at their complete financial picture. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. The IRS just released the 2026 tax brackets, and there's good news for families. They've adjusted the income limits to account for inflation, which means you'll need to earn more money before jumping into a higher tax bracket. Let me give you a real example. In 2025, if you're single and making $50,000, you hit the 22% tax bracket. In 2026, that same income now maxes out at 12%. That's a full 10 percentage points lower. Now, I know some of you are thinking, Ron, this is great, but what does this really mean for my household budget? That's exactly the right question to ask. Story time. I worked with a family last month, married couple, combined income of $150,000. They were focused entirely on paying down their mortgage faster because they hated their 6.5% interest rate. They'd been making extra principal payments every month. When we sat down together, I asked them a simple question. What's your blended interest rate? What's your household blended interest rate? They looked at me like I was speaking another language. So they had that mortgage at 6.5%, but they also had 2 car loans at 7.8 and 8.2%, a home equity line at 9.5%, and about $18,000 in credit card debt averaging 22%. When we calculated their actual household blended interest rate, it was over 11%. So here's what the 2026 tax changes mean for them and maybe you. The standard deduction for married couples filing jointly is jumping to $32,200. That's real money. That reduces your taxable income right off the top. But here's where strategy beats rate always. This couple was throwing extra money at their lowest interest debt, their mortgage, while carrying high interest consumer debt. It's like trying to fill a bucket with holes in it. After we repositioned their debt strategically, we freed up $840 every single month in their household budget. That's over $10,000 a year. And with the new tax brackets, they're keeping more of what they earn. Now, some folks might say, too good to be true, Ron. Let me show you the numbers. Their mortgage payment went from $2,800 to $3,100. Yes, up $300. But their other debt payments dropped from $1,650 per month to just $510. Net result, $840 more in their pocket every single month. The tax bracket changes 2026 make this strategy even more powerful. When you understand what's really coming out of your household budget, you can make better decisions about where your money goes. Here's something most people don't know. The IRS adjusts these brackets to prevent what they call bracket creep. That's when inflation pushes you into higher tax brackets, even though your buying power hasn't really increased. They're trying to keep more money in your pocket. The question is, what are you doing with the money you're already earning? Let me give you another example. I had a listener reach out last week. Single filer makes about $60,000 a year. With the 2026 changes, more of his income stays in that 12% bracket instead of jumping to 22%. That's a win. When we looked at his complete financial picture, he was paying over $900 a month in consumer debt, personal loan, credit cards, and a signature loan he took out 2 years ago. His household blended interest rate was nearly 16%. So what does this mean for you? Tax bracket changes are great. Lower taxes put more money in your pocket. But if that money is walking right back out the door in high interest debt payments, you're not really ahead. Think about it this way. Through safety, liquidity, and return, that's how I evaluate every financial decision. Is your money safe? Can you access it when you need it? And what return are you getting? Paying down a mortgage early might feel safe, but it kills your liquidity. Every dollar you put into your house is locked up, and you're getting a return equal to your mortgage rate, maybe 6 or 7%. Meanwhile, you might be paying 18% or 22% on credit cards. That doesn't make sense. The 2026 tax changes give you an opportunity to keep more of what you earn, but only if you're looking at your complete financial picture. not just one piece at a time. Here's what I want you to do. Don't just celebrate lower tax brackets. Take a look at what's really happening with your money. What's your household blended interest rate? How much is actually leaving your household budget every month? Strategy beats rate always. And right now, with tax changes coming in 2026, it's a perfect time to get your financial house in order. Head over to rsrlinks.com/keysteps. rsrlinks.com/keysteps. And let's take a look at your complete financial picture together. Find out where your money is really going and how to keep more of it working for you instead of against you. I am Ron Siegel, certified liability advisor. Remember, it's not just about the tax bracket you're in. It's about what you do with the money you get to keep. That is the Borrow Smart segment brought to you by GetHomeSelect.com, GetHomeSelect.com. And as always, I ask, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. Big thanks to Josh and Sean who are engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990 at ronsiegelradio.com. And remember, make a lot of money so you help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.